maybe it's just Jerome Powell matured in the way that he has taken his position and stance. But when he came in 2018, then COVID happened. Trump more or less bullied him into lowering rates to nothing. And now Trump is coming out calling him Mr. Loser, Mr. Late. And he's sitting back going, I know what I'm doing. I feel comfortable in my stance. I'm not being bullied by the...
In the moment, you're right. Like, Jerome Powell is trying to have the steady hand.
Yeah.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, joined by Eli Freeman.
Excited to be here.
And John Martfeld.
Morning.
And today we're going to talk about all kinds of fun stuff. We're going to start with recessions. But before we get started, any words of wisdom for the listeners?
Well, fun stuff and recession does not match, but that's the only words of wisdom I have so far.
Trying to keep things light.
No, I've got nothing.
Nothing? Okay, so recession. So the R word, right? Everyone, it's like this big scary thing that you hear the media it's like they use it to sell, right? I mean, that's the reality of it. But it is a little scary when you hear that and you hear them talking about it the way they are these days. So what does it mean? What's kind of history say? And all of those things. Wanted to touch on that. So I had a chart that we're looking at here, 35 recessions in the U.S. since 1854. So we went back.
Who was tracking back in 1854?
Yeah, I don't know.
I think Lee was. He's not here today. I can pick on him.
But yeah, since 1854. What's interesting is, as you can all see when you're looking at this chart, the recessions back in the late 1800s, the early 1900s, they were much closer together, so they were more frequent, and quite a few of them were pretty long lasting. Over the last 50, 60 years, they've been typically more spread out and a little shorter lived. So thoughts on why that might be the case? What changed in the 30s, 40s?
World War II. Right. I mean, we became a powerful nation after World War II, basically bailing out Europe, and we became we had the least amount of issues. We didn't have bombings in our country, and so we kind of started
people
bouncing
became more
ahead
dependent
of,
on us, and we were less dependent on others.
And I think that's the main cause of that, is that we just became a bit more of a global power from World War II on.
Yeah. It's also
accelerated under Reagan.
It's also when you started to see like the Fed get more power, and more involved in how they were managing things.
There's also an underlying theme, along with what John just said, of our economy becoming much more self-reliant and self-sufficient. The more that we rely on other economies to provide for our economic backdrop, the more that there's a chance that a recession is going to come based on either currency changes, something going on in other countries. Whereas if we're able to maneuver economic cycles by just doing economic policy here in America, then it allows us to kind of, and you'll see it in this chart, the more that we are energy reliant on just ourselves and less reliant on other countries, then recessions start to spread out more and more. Because like you said, we were averaging one every 5 years. Well, if you look at this chart, in the last 15 years, we've had one. And that one was COVID, so it lasted 2 months, and it really wasn't even much of a recession when you think about it. So we haven't seen a recession in the last 15 years, one of any kind of breadth or strength.
So some of this is like when I was talking about the Fed. If you go back to 33, so it's when Roosevelt, he suspended the gold standard for domestic transactions, so that meant U.S. citizens were no longer allowed to exchange their money for gold. So that was when that kind of started. In 71 is when Nixon officially was like, hey, we're, the international convertibility from the dollar to gold, which was effectively kind of keeping somewhat of a loose gold standard, was still there, and Nixon kind of finally, nixed that, no pun intended. But in 33 and 34 was when we had the Gold Reserve Act, which raised the price of gold to 35 per ounce. So this is where it's just interesting. I'm not smart enough to make the direct correlation of like this is exactly how this has impacted our economy, but that is right around the same time you started to see these recessions be more spread out and quicker because we had a lot more control and power, you might say, to influence our monetary system and, you know, how that was being. And you've only seen that power grow, you know,
No, I
then.
agree with all that. I think Reagan taking over in the 80s and basically going from the Keynes way of thinking on how we do stuff to what's the one I'm drawing a blank? I was drawing the one I like the most.
Friedman?
Friedman. There you go. Milton Friedman. Yeah. So you go from Keynes to Milton to Friedman. That is also, so Keynes is more government spending, more government relying on government.
Right.
And
government spending to stimulate the economy.
Yeah. And Friedman is more capitalism driven. And I think that the 80s on, and I say 80s through the 90s, we had a massive run up in our economy and a growth, and our technology sector has been so big in our world domination, if that makes sense. And that kind of started robustly in the 90s. And it's kind of continued on. We had the tech crash of 2000, but that was a
speculative crash.
Speculative crash, right? And then since then we have just been the beacon of the world in technology and, again, being a world power. So if you look at that chart of every 5-year average recession in the U.S., if you look at other countries in the world, to Eli's point, they rely on us. We don't rely on them, right? So when we have a recession, we pretty much drag the rest of the world with us. But other countries in the world have recessions more often than we do. Sure. If that makes sense. So just being the head of the game, being the largest consumer in the world and so on, keeps us from, and I think that expands that out where we're the most, we're just the best economy in the world. It keeps us from having.
Could this also, and this is maybe going to ruffle a few feathers, but could this also mean that the Federal Reserve is getting better at their job?
It's going to ruffle my feathers.
Yeah. No, I would say no.
Positively no.
I would say,
No
do they have a
chance.
better understanding of how their influence and decisions impact things? Yeah, but I don't view that as them getting better at their job. I just view that as like learning from mistakes and like you have more real data to work off of because you've.
That just sounds better to me.
No, but saying that they're getting better at their job is like admitting that they're doing a good job, or at least it feels that way. So I refuse to say they're getting better at their job. So no, I don't think they're getting better at their job because
they might have better tools, but not necessarily doing better with those tools. I think this current Fed is.
I think they're getting
messed up.
I think like a lot of politicians, they've gotten so narrow, short-term focused that in a lot of ways they've gotten worse at their job because they're so worried about, the immediate, like what is the next quarter, the next year going to look like that. And they've done that for so long that we've got ourselves in a tough spot.
I might actually take the other side of that only because I think you look at what is the Federal Reserve's job. Well, the Federal Reserve's job is not to run a budget. So they have no control over the budget deficit. So you separate that out and you say, well, the Federal Reserve's job is to keep inflation low and unemployment low. And you look over the last 10 or 15 years, and they've done a relatively good job. There was the spike in 2022 of high inflation, but you look at a 15-year period, and inflation's averaged a little higher than 2%, a little under 3%, and unemployment's at a basically all-time low at 4.6%, with the 30-year average being 5.7%.
But this is where I would say, their goal is to keep inflation low, but I think they got kind of greedy, and this is where I don't think they've done a good job. Because inflation was low, and they continued to do things that they didn't need to do.
For example, they kept interest rates low artificially forever.
And they kept increasing the Fed balance sheet. And so they were using things in their arsenal that got us in a spot that thankfully we've been able to get a little bit better position moving forward. But they got us in a spot when like we didn't need that ammunition.
I agree with that.
Right. And so like they let things go for 10 or 15 years. And I honestly think it was nothing but greed. It was like, hey, things are good. What we're doing is like, quote unquote, working. Let's not worry about like what position it's going to put us in the future. Let's just keep it running as long as we can keep it running. And ultimately, then we had like COVID happen. And, it's just, I don't think they've done a good job. I think they're like any other large, powerful government entity, even though they're not supposed to be government, directly. I think they get greedy. I think they get, like hungry control. Like,
I think you're right. I think it's a lot like
I think it's only an issue that will grow, because I don't believe that humans in and of themselves have it in them to have the humility to step back and say, like, hey, you know what, we need to actually be less involved, and admit that we don't have as much control on some of this stuff as we'd like to think. And so I think it's just kind of an ever compounding issue.
During COVID through now, not one Fed chairman meeting has somebody asked the Fed chairman about the M2 measure of money supply. Not once. And that is a massive, massive piece of information that we should have been talking about. And that's when you print money for nothing, basically, when we just print money. And we did that for COVID because it was non-productive printing of money to give to our business owners, to give to our employees, whatever, that weren't working.
Was that initiated by the Fed?
It doesn't matter where it's initiated from. The point is the M2 measure of money supply is a Fed key data point that they should be measuring, and they were not. Nobody was holding them accountable. Yes, it's their job to know that and to protect us from that, and that piece of the pie during 2020, when they said inflation was transitory, they were wrong. Inflation was not transitory. When you print dollars from nothing, you create inflation. That's the exact point of inflation, is when you print money from no productivity. That in itself creates inflation. So the idea so my point is, I guess, it doesn't matter where it came from, whatever, they missed that and nobody pressed them on that. And it's almost as if, they have certain things they can't ask in a press meeting, because great economists, and I've read a ton of them, have raised that question many times, but they're not in the meeting to ask that question, right? And it's our media people, and I think they have a set line of stuff to protect that. And I think that's happened with our political officials as well. There's tough questions that don't get answered and don't get asked. So I think there's, to Matt's point, it's like the bigger and government gets, the greedier that we get, the more power we think we have, the less we think we have to be held accountable. And I'm not saying that it's not an easy job. There's no way I could do it. I'm not as smart as Fred Chairman, of course. But I do think there's things that they have
they're just too involved. You can't. Yeah. What are your thoughts?
I think that oftentimes we couple our political dissonance, our political struggles, and we pair that just directly to the Fed. And the Fed has an incredibly difficult job of managing what Congress and the president are pushing forward and trying to navigate around that from a monetary fiscal side. Because I would argue just the same of the inflation that was created came from fiscal stimulus that was created not from the Fed. PPP loans, stimulus checks, those things weren't created or masterminded by the Fed. They had to deal with the repercussions of them and should have, to your point, increased rates earlier, knowing that was going to increase money supply and we needed to decrease some of the demand for mortgages and loans. But I think they have a very difficult job, one that they've navigated what I would consider like pretty good. We've got unemployment rates low. We have inflation at a relatively low place. But again, our fear is that inflation spikes. Well, the spike in inflation is coming from tariff expectations, and that's not within their control. So I think they're in a pretty difficult position navigating the political changes back and forth while they stay steady. Like Powell started in 2018.
Sure.
Yeah. He's seen Trump, Biden, Trump. And I mean, he's got
completely different stuff.
Completely different.
My thing with the Fed is I just like this is going to sound crazy, but like I wish we were on the gold standard. I wish we could go back far enough where it's like there was a rhyme or reason to what happened, and we were less reactionary and things. Yeah. So pros and cons, right? Maybe we can smooth things out, have fewer recessions, and they're shorter because we have Fed and they're very involved and they can manipulate things. But I also just think, okay, like how long is that sustainable? When you're trying to come in, right or wrong, and even if you think they're doing a good job, but when you're trying to come in every time there's something that's naturally occurring and you're trying to manipulate it and smooth it out or soften it by pulling different levers. I've just always been a believer in like free markets where it's just like, no, just like let the markets flush out what they need to flush out.
2008, 2009, we stopped the reserve requirement for banks. The reserve requirement for banks forever was 10%, right? And if a bank fell out of line from 10% one way or the other, they had to sharply get back in line. And there was a lot of trading between banks and so on to get that to happen. And that happened forever prior to 2008 financial crisis. So when we took that away from the banks, right, and then you took away the reserve requirement, well, it didn't hurt our economy at all from 2008, 9 until 2022 or 2020. When interest rates went back up, because interest rates were low for so long that banks didn't take advantage of that. But now you have, in 2022, for example, you had banks with 40% reserves when they were held to 10% prior to 2008 because they were making 5% on their money. And why would they lend that out to the public or lend that to a risky, for 6% or 7% or whatever, when they're making 5% free? And all that goes back to Fed policy, goes back to our government involved in that. I think there was mistakes made all the way back to 2008. We just didn't see the ramifications of that until 2020 and beyond, and that goes back into COVID. But when the Fed had to raise rates, then it became obvious that that was a mistake 14 years before. And they did it 14 years before to avoid a massive bank crisis. And they thought banks were going to go bankrupt, and they thought the world, America's economy was going to just fall to the bottom. So they did it in a reactionary thing to think that we were going to go into Great Depression, when the reality is if we'd have just let capitalism do its thing, yeah, we may not have Bank of America. We may not have a couple banks that were bailed out, 100% bailed out, because they were such bad actors for the previous 10, 15 years, and we bailed them out.
Yeah.
So that's where I get a little upset about. It's like it goes back further than just the last couple of years. And Chairman Powell, it's not his problem, right? It's not his fight, because he joined later under Trump, right?
2018.
He had to take over this stuff. So I'm not picking on him specifically. I'm just saying, like, the Fed in general.
What I would like to see, and I'm not a Fed hater, but what I would like to see is like a Fed chairman get up there and be like, you know what, this is what we see happening, but we also think this is part of like the normal market cycle, and we're gonna just kind of like let it happen.
Let it bleed.
Like if they could have more of that approach on a more regular basis, then what?
It's kind of like what Jerome Powell's doing right now.
How so?
Because he's talking, he's giving commentary, but he's doing nothing.
No, but see, when he said that,
but just because he's doing nothing, they're not going to be able to do something every time they have a meeting, right? But you don't hear them come out and say, "Hey, there's some actual like negative things happening, and we're just going to like let it work itself out."
Also, on the inflation front, 2022, he came out very clearly and said, we will continue to raise rates until inflation gets back down to our target number of 2.5 or 2.3, whatever it was. And he did not. They stopped raising rates prior to getting to that point, right? And I kind of think that they maybe should have pressed the button a few more times. And then as we got to that point, then you soften it back down. But he didn't. So he didn't actually do what he said he was going to do back in 2022. And I wish he would have kept doing that. Now I wish he would lower rates. And I think there's lots of reasons why I'm kind of hoping that happens. But
see, I wish they would just get out of the way.
Well, if they'd get out of the way, it'd be great. I think the
so to that extent, it would be
right now.
set a target federal funds rate and leave it alone. Don't do any fiscal stimulus one direction or another.
Well, I mean, not saying any. I'm not going to go that. But, like, I think having some rhyme or reason. Like, and some of this is maybe just my own personal beef with them. But, like, give us like, why is 2% the inflation target? Everybody asks
a historical
about
number that's not even.
Everybody asks, just
number.
like, come out and explain that, or admit that it needs to be a different number, right? And then tell us what and when you're going to do what we think we, like, to keep that in line. I feel like you've got a group of people that have a lot of power that get in a room and they come out. They either need to make decisions and not talk about it, or like actually try to explain instead of just give us some numbers, because, it wasn't too long ago, like they didn't say anything, right? We didn't have all these press conferences, and I almost wish we'd go back to that,
Me too.
or they would actually explain where some of this stuff is coming from.
Since the internet and all that stuff, we have so much more, and 24-hour news cycle and all that stuff. They have to fill time.
It's just like Trump.
It's ridiculous.
They just need to shut up sometimes. Like, they just need to stop talking. It's like, what they're doing might actually be the right thing.
Mm-hmm.
But like, just stop talking about it, right?
Stop talking.
Because
I
like the
agree.
markets react, and the market, or
Oh,
they
yeah.
get spooked based on one or two words, or
Oh, yeah.
or it's like, wait, did he say that just? Is he actually going to do that, or did they say that just to like?
Yeah, I guess
Say the words.
most of that is very little of my concern because that all gets flushed out over time. Like you get those short-term reactions that come from it, But
But goes back to my point. Like, why even do it?
yeah. I'm not a big Fed lover or Fed hater. I think they've done a perfectly fine job with the mandate that they have in front of them, and I think they have a really incredibly difficult position of being kind of the middleman between.
I agree with that for sure.
So
I definitely agree with the second point. I don't agree with the first point. I totally agree with the second point.
Yeah.
And I think they've been in a tough spot. I think Jerome Powell's been in a tough spot for sure.
Yeah, and Trump coming out, and I wish Trump
publicly
would just stop.
chastise him and stuff. It's just stupid.
Yeah.
Like his term comes done in May of next year, I believe. He's got one more year, Jerome Powell. Like that's
no
the
idea.
term.
Yeah.
No, that's the term. And then President Trump can pick a new Fed chairman, which obviously he will if he doesn't, force him out sooner.
Yeah.
But to your point, like, golly, can we just have a moment where we don't have to talk about everything that we're feeling?
So for those of you who don't know what we're talking about, Trump came out yesterday and called the Federal Reserve Chair, Jerome Powell, who he put as the Federal Reserve Chair, Mr. Too Late.
Yeah.
And a major loser.
Major loser. Yeah.
Yeah, those are not presidential things to say.
Yeah.
Yeah. Silly.
Anyways, yeah. Well, to kind of wrap up this conversation, because there's a lot about what the Fed does that I don't understand. I've just always viewed the Fed as very similar to the government. I just think smaller and less involved is better.
Far
Doesn't mean that they don't have a role and don't need to be there, right? Just like government. I mean, I'm not like anti-government, like we don't need a government, but I just generally think like the fewer decisions made over the long term probably works out best for everybody, the less you try to get involved. And so that would be kind of how I summarize my opinion on the Fed.
Less is more.
Yeah. So
So
and Powell, and to your point, and then we'll pivot, but to your point, Powell is kind of trying to stay out the way because he is making fewer decisions now when a lot of people are putting pressure on him to do something.
Because last time he, and maybe it's just Jerome Powell has matured in the way that he has taken his position and stance. But when he came in 2018, then COVID happened. Trump more or less bullied him into lowering rates to nothing.
Mm.
And now Trump is coming out calling him Mr. Loser, Mr. Late. And he's sitting back going, I know what I'm doing. I feel comfortable in my stance.
Yeah.
I'm not being bullied by
Yeah. In the moment, you're right. Like Jerome Powell is trying to have the steady hand.
Yeah. So interesting thing, Ryan Dietrich, he's on Twitter. He posted the S&P 500 is down 14% since President Trump took office on January 20th, 2025. Here's a chart. We'll put the chart on our YouTube channel. So if you're listening on Spotify or somewhere else, just go over to our YouTube channel and look at this chart. It says here's how the past 32 first 100 days of a term back to 1900. As of now, this would be the worst first 100 days out of all presidencies. So currently Trump is on his way to have the worst first 100 days in office.
Who are the next, like, I don't know if it shows that. Like, what are the other worst?
Let me move the microphone so my eyes are getting bad.
You're too young to have your eyes get bad, Eli.
Richard Nixon, Franklin Roosevelt, Woodrow Wilson. I don't remember back to 1913.
Okay, we're going a ways back.
Well, okay, I'm going to
interesting.
comment on that. All right, so I'd love to see where Reagan fits in on that because I know after Reagan was elected, the market went up a day after election, and then it was down.
Reagan's first was negative 1% for first 100 days. Reagan's second was up 5.4%.
Yeah, the second one would be great. I was thinking more to his first one. Here's the deal. When you do a 180, I don't care what president comes in, if you're the opposite party and you do a 180, you stop everything that was going before and you restart you change everything, you're going to create massive fear. And then you couple that with the fact that basically 95% of the media, there's a great article about news stories on presidents going back to George Washington, positive and negative news stories in their entire terms. President Nixon had the most negative stories on him as a president while he was in office of any president in the history, and it was 45% negative stories to 55% positive. Mm-hmm. Trump's first term was 93% negative, 7% positive. And our market soared. Things were great. Economy was great till COVID. You go to this time, and it's about the same. It's about 95% negative, 5% positive. So everybody hears everything negative about everything he's doing because they want him to fail. I mean, Bill Maher's come out, he went to the White House and talked to Trump, but then he comes out and says he wants a recession so that Trump will change his mind on tariffs and so on and so forth. There's a lot of negativity and when you throw a little spark of the tough tariff talk, which is really tough, and sometimes, as we talked about in here, I do not like the way he does things, talks too much and so on.
Tough and erratic.
Yeah, it seems tough and erratic, but I actually don't disagree. I did some research on our deal with Canada, because I thought that was the one Trump was really wrong on, and I was really upset at him for going so tough after our lovely little neighbor to the north. And I don't know that's how you say it.
Every Canadian is now insulted.
Yeah, exactly. So I did some research on that, and I'm like, oh, no, wait a second. Going back several presidencies, not just Trump, Canada has done some things that are against the USMCA agreement, some pretty harsh things. And you can research it. I won't get into that. But there's a lot of things that aren't glowing about that relationship, and Trump is exposing that. And I don't have a problem with kind of holding people accountable and making fair trade. I agree with all of that. Just the way he does it sometimes is very frustrating. But on the same side, when you have everybody against you, the media against you, the world against you, and you're trying to do tough things.
I mean, talk about being in a hard spot. So we can all have kind of sympathy and appreciation for Jerome Powell, just the spot he's in. I mean, President Trump, you come in, remove the man, Mr. President Trump, just anybody in that position. If you come in, you're like, hey, we need to get a lot of things done and really go about things in a different way. I mean,
he's shaking.
You can't come in and be like, as much as I don't agree with how he's done some of the things, been very erratic and just kind of. I also know you can't come in and be Mr. Nice Guy and expect to get things done, because that's. You look up in 4 years, there's another election, and you're like, hey, we didn't really get a whole lot of this done, right? And so I definitely see both sides of why he would almost kind of need to come in and do things the way he's done it. You kind of wish he didn't have to.
Yeah. Or he did it nicer.
But, yeah.
And the flip side of that, going back to this chart, is it almost feels like he came in saying and knowing it's going to be rough.
Yeah.
And you heard it from Elon before President Trump was elected, and then you've heard nothing of form of remorse or sympathy from the White House in regards to how much the economy, or not the economy, but the stock market has declined.
Trump even said, he came out and said hey, we might have a little rough patch, kind of short term.
Think about the market was at all-time highs, right? We hit all-time highs in January on all three. I think NASDAQ, S&P, and Dow hit all-time highs in January. So you think about how, number one, we're at an overpriced market, been going bull run since 2009.
Not anymore.
No, not anymore. And then you take into the fact that we're doing these things that are scary, create fear, and then you couple that with the fact that everybody's kind of against, no matter what he says, it's kind of against it. It makes perfect sense that we're going through this, but we're at all-time national debt highs. There are things that we have put ourselves in, not Trump, but I'm talking about all our government for a long time, that we're eventually going to have to pay the price for.
Sure.
Right? And one of that is the national debt, which is another story, but part of this stuff is to try to curtail the national debt. You think about it back to when Bill Clinton left office, we'd had a balanced budget. It is so frustrating to think, if you're an American citizen, how we've and it's not the presidents that have let this happen. Some of it is on presidents, but largely our Congress that has just spent like drunk sailors for 25 years.
Yeah.
And now we're in this really bad pickle. So somebody's going to have to be a tough guy and get it fixed, or eventually we're going to collapse regardless.
As bad as things feel, when you look at the S&P 500, we were at these levels in August.
Yeah, we gave up 200.
Just a minute ago.
As of last week, which is a little bit higher than we are right now, we had given up 242 days worth of gains.
Yeah.
So we hadn't even given up a full year's worth. If you look at the past recessions, and this is coming from Warren Pies, and he says that the average is about 400 days worth of give back. So
Okay.
We're not.
That's interesting.
And basically, he was building out the case between a recession case and
Yeah.
a non-recession case. So
Hey, PE ratios, last thing I'll say, when we hit 37,000, and again, I use the Dow. I know you guys don't use the Dow. But
Yeah.
when we hit 37,000 on the Dow the first time, coming up, and that was in 2000, before COVID, we actually were, we had a PE ratio like almost double the historical average. When we fell down into the 37,000s last week, or a couple weeks ago when it was, we were actually at a PE ratio around a little between 17 and 16, which is real close to historical high. I mean, a historical average, which tells me that the stock price, the earnings had caught up to the, we were consistently overpriced, and we kind of fell down to where we are kind of baseline. And I actually think that was a healthy pullback. I mean, I'm hoping that we don't go back down there, which is my worry, and touch it again and go and beyond.
Well, it almost feels like we just went back to average. So we sold back to average. Yeah. Now we're waiting to see what happens.
See what happens with tariffs and taxes.
If tariffs and taxes start to really turn around the economy, then we'll get underneath the average.
Exactly.
And if tariffs don't play out in any kind of form of significant way, we might get back to an excited American exceptionalism. America's the best country to invest in, and companies are growing. So, I mean,
what's crazy is when you the last several years, there's just been extremes on both sides, right? You had COVID, the lows of COVID. You had roaring bull markets. Yeah. You had 22. 22 was a rough year.
For everything. Fixed bonds, income, everything like that.
Yep. So 22 is a rough year. When you look back, you can cherry pick these time periods. We were talking about this yesterday.
I hate time periods.
Like, you can cherry pick different time periods and like make things look really good or really bad. Yeah. But if you just, and so that was my confession.
Are you about to make it look
bad? That's what I'm about to do. But no, if you look at the last 3 or 4 years, the Qs, NASDAQ is better, but I'm just looking at the S&P 500 and the Dow. Over the last 4 years, 4 years is not nothing. That's a decent period of time. The S&P has averaged 5.86%, and the Dow has averaged 3%. If you look at the last 3 years, it's just slightly better, 3.5% and just over 6%.
And if you talk in real terms, it's like a 2% return.
Well, yeah, for sure,
no doubt.
And so it is crazy. Like, that's over the last 3 years, the last 4 years,
with the wildness of This is why 2000 to 2010 was the decade of flat. Basically we didn't have a good. But if you go back to that, and I was in the market in that time, it's exactly the same. We had wild swings in that time frame, and you could make money, you could lose money, But at the end of the decade, it was like a lost decade. But yet, it was a lot of money could have been made.
Sure, and nobody in 2004 knew that, hey, we're going to be here in 2010 and look backwards and be like, hey, nobody made any money if you just own the industry.
Exactly.
Right? And so you don't know when you're in it, but. Interesting times, to say the least. Well, I don't really know what we accomplished today, but we did a lot of talking. Talked about the Fed. Talked about Trump.
I'm going to think about what Eli said. I'm going to dig into it because I kind of like the optimism of the Fed. So I'm going to get maybe try to turn my frown upside down, see if I can look a little bit deeper into it. But it was a good
Eli is he's an optimistic
I'm an
guy.
Eternal optimist.
Yeah.
I will find the good in everything if I can.
No, it's great. Don't become a
grumpy.
Well, good conversation. A lot going on. And so I'm sure there'll be a lot that happens between now and next week. But
oh my gosh.
Hope everybody had a great Easter weekend this past weekend. We appreciate you guys watching and listening. As always, give us a like, subscribe, send us your comments and feedback, and we'll look forward to seeing you guys next week. Thanks.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.